Hello friends, welcome back to part 21 of my Tesla earnings forecast review video series for 2022 Q3. I guess I don't have to keep saying the entire name every single time. You probably have watched a bunch of the previous parts if you're watching this one, because we are very deep into my detailed model now. So in part 20, we reviewed these numbers, which are the total Tesla deliveries by site and by model. And the next section here is total automotive revenue per delivery by site and model. So now we're looking at amounts per delivery is what's going on in the next couple of sections. So these numbers, as we discussed in some of the charts early in the series, used to be really high because S and X used to be most of the mix, and you can kind of see early Model 3s were mostly performance Model 3s that cost over 80 grand. People forget because Model 3 got so affordable so quickly, including selling some $35,000 Model 3s in Q2 of 2019. They were off menu, but you could get them, and there's YouTube videos out there you can still find of people who got them and reviewed the $35,000 Model 3. But yeah, the ASP fell pretty quickly from 80 grand down to less than 50 grand. Hung out there for a while. Model Y got introduced, and its ASPs were higher by, 10 or 15 grand-ish, something like that. We never get exact figures from Tesla on this stuff, but this is the best we can piece together from what Tesla does report. Always a little bit of mystery to it. So here we are in 2022 with the first half of the year already done, and the rest of these columns are my forecast for what's going to happen in the future. And these are total automotive revenue per delivery by site and by model. And I guess in this case I'm not doing it by site, I'm doing it just by model, but in the case of the S and the X, those are only made at Fremont. So we're going to continue to see ASPs rise on these in the forecast to go months because the price increases haven't gone fully into effect yet for the people who are buying Model S and X today. Some of them placed their order when the price was lower, but the further into the future we go, the fewer buyers there will be who purchased at a price lower than today's starting prices. For Model S and Model X, that's what's going on here. Then for Model 3s, those prices have also been rising, and we can expect that to continue, which is what I have in my forecast. Same with Model Y, total revenues higher. What's driving these? We're about to see that in the next section, actually. But before we leave this section, I'll just comment that probably I'm going to take my semi-revenue per delivery up from here. $180,000 is probably not enough revenue per delivery for future quarters. I imagine Tesla is going to honor the pricing they announced a long time ago when they started taking orders for semi, because those are corporate buyers who probably expect to pay the price that they reserved at. So that's what those are doing. And I'm probably going to raise the quarters in especially 2024 to be a lot higher than this because costs have risen by so much since that original pricing sheet was announced by Tesla. Okay, what's in this next section? Well, it's a different way of breaking down the same numbers. So if these totals at the bottom seem familiar to you, it's because you just saw them. Here, these amounts are the same amounts as the bottom line amounts here, and what you see above it is the breakdown of where they come from. So there is a cash buyer ASP subtotal in the middle of this page, and what's above it tells you what we saw in our detailed section. So in part 11 of this series, we went through for every model at every site, for every option, how much we expected the price and the take rate to be to build up to that model's revenue. And what we see here is the total for all models combined by option type. So this section is giving you how much the buyer expects to pay based on what choices they made in the design studio configuring their Tesla. So that gets you to the cash buyer ASP, and then we have to make adjustments below that for stuff like leased vehicle buyers. Some of the deliveries, it's a minority of deliveries, a small number, but those deliveries aren't getting the full retail value of the Tesla over the life of that sale or that lease. They're just getting payments for 36 months typically, and then the lessee has to give the Tesla back to Tesla, who can then sell that as a used vehicle, right? So since you're not getting all of the revenue from those deliveries, there's a contra revenue here to back off some of that amount because not everybody is a cash buyer. Then there's the destination and delivery fee everybody has to pay. There's regulatory credits, which are not paid by the purchaser of the Tesla. They're actually paid by Tesla's competitors who did not produce and sell enough electric vehicles to comply with applicable law. So they have to buy regulatory credits from companies that produced more than they need, companies like Tesla, that only produces electric vehicles, to avoid paying more in fines to the governments who require them to produce more and sell more electric vehicles than they did. Then there's other automotive, which includes the FSD deferrals, after-the-fact upgrades, data plans, stuff like that that would hit automotive revenue as other. And that's how you get to the total automotive revenues here. So what is the primary driver of total automotive revenue per delivery growth over time? Well, you can see it's mostly coming from this full self-driving line. As time goes by, and as the price of FSD increases, as it has been, and as the take rate increases, which probably it has not been recently, I mean, we're probably going to see a decent spike at the beginning of Q3 from people who would rather pay $12,000 than $15,000 before that price increase went into effect in North America. And then in Q4, we'll probably see a lower take rate at a $15,000 price point, especially if those buyers aren't even guaranteed access to FSD beta without getting a good safety score and waiting. But as those features roll out and become better understood, and as the market values those features, more people will take FSD and pay for it at full price, and that's what's going to produce additional revenue per vehicle. So that's where this ASP growth is going to come from, and then really ramp up toward the end of 2024, which is when I'm assuming there will be a global rollout of FSD features to the entire fleet as the neural nets figure out how to drive more safely than a human driver. So even if these are still technically level 2 advanced driver assistance systems, I think by this point they'll be so capable and interventions will be so rare that the market will have figured out by then that Teslas are offering a completely different driver assistance suite than anyone else has. It's way better, and it's worth that amount of money. So that's what's going on with my ASP growth over time. Then I've got some lines here that are totaling up a few of the things above. So here's the full self-driving at time of purchase line that's part of the cash buyer ASP on new vehicle deliveries. And here's the line that has that all other, including FSD deferrals and after the fact upgrade purchases and acceleration boosts and whatever else is in there. So that's a number that you might care about knowing what the net is. The bottom line number here used to be a negative number because more FSD revenue was being deferred than was being declared as revenue in the period in which those vehicles were sold, because less than half the features were available. But nowadays, instead of it being a very small number per vehicle delivered, it's more like $2,000 or $3,000 per vehicle, probably, is what's in my forecast. Then I've got a few earnings per delivery numbers here. So I've got GAAP and I've got non-GAAP, and these are just looking up the page where we saw those earnings figures reported earlier. So Tesla used to lose money a long time ago, so there were negative numbers back here in terms of GAAP and non-GAAP earnings per delivery. In some quarters, they were big. Q1 of 2019, there were logistics problems that quarter trying to get a lot of vehicles delivered, and they didn't make it on time, so that was a bad quarter for earnings. But mostly since then, it's been profits. And those profits per delivery have been growing from, barely anything to, 2,000, 5,000, 10,000 as of Q1 of this year. And by the end of this year, I think it's going to be about $15,000 or $16,000 earnings per delivery. By the end of the next year, closer to $20,000 earnings per delivery, which is world class. There are hardly any, if any, manufacturers on Earth today that are producing 20 grand per vehicle worth of earnings, bottom line earnings after paying for all their corporate expenses and taxes and such. So there's also an adjusted EBITDA per delivery number here. So these are higher than earnings because they are before the interest, the taxes, and the depreciation and amortization, which is what EBITDA stands for. So these are a little higher if you prefer the adjusted EBITDA per delivery metric. We also have EBIT per delivery, and these numbers are pretty close. They do take the hit for depreciation. And this is almost exactly the same number for Tesla as EBT, earnings before tax, because the interest expense is almost nothing now for Tesla. And going forward, I expect Tesla to carry no long-term debt of any consequence. So, yeah, these numbers are looking good. Tesla's balance sheet has never been stronger than it is today by paying down long-term debt early. Expect there to be an investment grade credit rating upgrade from Moody's and S&P and the smaller players in that field. Long overdue. I mean, that upgrade should have come through more than a year ago. But it's just embarrassing to those companies that they don't have Tesla upgraded to some credit rating that has no B's in it. It should be A or better. Tesla has one of the strongest balance sheets in the world at this point. And credit rating upgrade is long overdue. So when that happens, more funds will purchase Tesla that were previously prohibited by their bylaws from buying anything below investment grade. So as a retail investor, you have a head start if you own Tesla shares before that credit rating upgrade goes into effect. All right, what do we have next? 12 trailing month deliveries is here. So over the 12 trailing months ended Q1 2022, Tesla delivered just over 1 million vehicles. And by the end of Q1 2023, that'll be over 1.5 million. A couple of quarters later, it'll be over 2 million. A couple of quarters after that, it'll be 2.5 million. So exciting times for Tesla, doubling over the next 6 months, the 12 trailing month deliveries number. Wow, that's something. Just phenomenal exponential growth continues at Tesla. Then 12 trailing month revenue is here, so also 12 trailing month adjusted EBITDA numbers. And this number is the 12 trailing month non-GAAP earnings per delivery. So this is just smoothing out this row so that it jumps around a little less and rises a little more smoothly. This number is on one of the charts that we reviewed earlier. And in that same video, we also reviewed what happens if you just subtract the regulatory credit revenue from that. I have regulatory credit sales down here. But I should probably save the next section for the next video and just say, if you have enjoyed today's video, click the like button. And if you're not subscribed to my channel, go ahead and subscribe to my channel. And ring that notification bell so when I publish fresh content, you'll have access to it right away. And I'll see you in the next one.